Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
I am so clever that sometimes I don't understand a single word of what I am saying. Oscar Wilde. I refuse to join any club that would have me as a member. Groucho Marx. The safe way to double your money is to fold it over once and put it in your pocket. Kin Hubbard. Go to heaven for the climate, hell for the company. Mark Twain. There are three kinds of lies, damned lies, and statistics. Benjamin Disraeli.
The $1 trillion club used to be dominated by oil, banks, and consumer giants. Now it's starting to look like a semiconductor industry conference. Of the 15 companies worldwide worth more than $1 trillion, 6 are chipmakers: Nvidia, Broadcom, TSMC, Samsung, SK Hynix, and Micron. That's an extraordinary concentration of value in one industry. Why? Because every major technology trend, AI, cloud computing, autonomous systems, robotics, and data centers, ultimately runs through one bottleneck: silicon. Back in 1997, Amazon went public less than 3 years after Jeff Bezos founded it, with a market cap of just $442 million. Today it's worth $2.9 trillion, a staggering 6,484x increase. Now compare that with SpaceX. After 24 years as a private company, it's expected to debut at a valuation of roughly $1.75 trillion. In other words, much of the explosive growth has already happened before public investors even got a seat at the table, or even will get a seat at the table. That's a real shift. Companies aren't staying private because they can't access capital, they're staying private because they can. The consequence? Some of the biggest wealth creation stories are increasingly happening behind closed doors, while public investors arrive much later to the celebration. Europe isn't just increasing defense spending, it's launching one of the biggest industrial spending programs in decades. European NATO defense budgets are projected to jump from 255 billion euros in 2019 to 500 billion euros in 2025, and then to a massive 800 billion euros by 2030. That's more than a threefold increase in just over a decade. What's especially notable is where the money is going. A growing share is earmarked for equipment: missiles, aircrafts, armored vehicles, naval systems, and defense technology. In other words, this isn't just more soldiers, it's more factories, more production lines, and more manufacturing capacity. 5 years ago, electric vehicles were still the future. Today, they are 25% of all new cars sold globally, meaning 1 in every 4 cars leaving a showroom now plugs in. The surprises aren't just Norway at 97% EV adoption, it's countries like Nepal at 68% and Singapore at 63% that have gone from single-digit adoption rates to becoming global EV leaders almost overnight. What's happening is bigger than a car trend. Batteries are getting cheaper, charging networks are expanding, and consumers are increasingly treating electric vehicles as a default choice rather than the alternative. Looking at this list, you would think earnings were just a suggestion. Several Indian companies are trading at 100x, 200x, and even 500x plus earnings, with one clocking in near 1,500 price to earnings. But here's the catch. A high PE isn't a verdict, it's a forecast. The market isn't paying for today's profits, it's betting on tomorrow's. If earnings triple, quadruple, or grow tenfold, today's crazy valuations can suddenly look reasonable. The danger comes when the growth merely arrives instead of arriving spectacularly. Markets are remarkably forgiving of expensive stocks that grow fast and ruthlessly unforgiving of those who don't. Just 2 years ago, India looked like the market everyone wanted to own. Today, the leaderboard tells a different story. India has slipped from number 5 to number 6 in global market capitalization, overtaken by Taiwan's $5 trillion market cap. Powered largely by one extraordinary force, TSMC and the AI semiconductor boom. Meanwhile, the US stands at a staggering $73 trillion, larger than the next several markets combined. A handful of companies, Nvidia, Microsoft, Apple, Meta, Amazon, are generating an outsized share of global wealth creation. The surprising part, this isn't a story about India losing. India's market cap has still surged from roughly $2.5 trillion in 2020 to $4.7 trillion today. It's a story about how aggressively global capital is rewarding strategic monopolies, AI infra, and semiconductor dominance.